Now, this week, to start, the oil markets have seen a rebound after a period of soft trading. It's driven by global tensions, the ongoing drone strikes on Russian refineries by Ukraine have kept the oil markets risk premium elevated, as well as the very sad terrorist attack in Russia over the weekend. Now, in the US, the number of oil rigs also decreased slightly, reaching 509 for the weekend in March the 22nd, 2024. So the total rig count, combining oil and gas, stood at 624, down from 629 the previous weeks. Now, speculators also showed increased confidence in the market, with net long positions rising for both the NYMEX WTI and ICE Brent futures contract. And overall, the market's optimism persists and upward momentum persists, supported by geopolitical tensions and investor optimism, particularly regarding supply constraints and an increased demand outlook. Now, you can see that clear uptrend has been in place. Now, looking at the seasonals, we can see we're also entering a period of seasonal strength for WTI crude oil. If you just take a look from March the 31st through to April the 18th, there is a 1.58% average return, 60% winning trade percentage, median return of over 3.5%, and there's been some outsized gains in 2001, 2008, 2015, with WTI prices rising over 10%. Now, the major trade risk here, of course, is obviously seasonal patterns aren't necessarily guaranteed each and every year, but there is a bias for gains during this time, and with oil sitting above major support at $80 a barrel, is this a seasonal pattern that's set to repeat, or are we likely to find dip buyers stepping in from that region? Sign up to on the text below for thousands of more seasonal insights just waiting to be revealed. Remember, don't just trade it, season exit.